The first point I want to make is, and I appreciate your talking about openness. One of the things that we do too little of, I believe, in our politics and our government is when people predict disaster, we don't go back and see whether or not the disaster occurred. And sometimes that can be very helpful. When Henry Gonzalez was the chairman of this committee, Mr. Greenspan was the head of the Federal Reserve, probably even before. I think he may have taken over when Mr. Volcker was chairman. He pushed hard for more openness. Back then, in the 80s, the results of the Open Market Committee weren't published, I believe, until the next Open Market Committee. People left to guess how the committee had voted. The question of the minutes came up. The first response, sadly, of the Federal Reserve chairman was to deny that there were minutes. Then later they were found in a drawer and made public. There were serious arguments made that the kind of openness that Henry Gonzalez was pushing for would undermine the conduct of monetary policy. Despite that, he was able to persuade the Fed to make these changes, probably out of fear that if they didn't do that, there would have been legislation which would have been, from their standpoint, harsher. And zero negatives have resulted. In fact, I think you were better off today. I don't know what you think, but if we were still in a period where the FOMC voted and people didn't know how they voted, the uncertainty, the ability that you have to influence the markets would have been greatly attenuated. So I say that we had a previous hearing. One of our colleagues, General Florida, Mr. Grayson, asked Mr. Cohen, who I thought was an excellent witness, forthcoming, thoughtful. I congratulate Mr. Cohen on his performance as a witness in being constructive. But he said, well, he couldn't give information about who the recipients were. I hope in this study of openness that it will be completed quickly and that you'll put a very severe test against these claims. And historic experience is that there is a tendency to claim damage when there isn't any. Next, as you know, we're in a very difficult political situation. We have this problem. We're going to talk about it again tomorrow. It is essential that we reinvigorate the credit system. We do not have the option of creating a whole new credit system. That means we've got to work with the existing. The problem is that there are a lot of people who are very angry at the people who are running the credit system. And we will have to do things that look like they are helping them, that may be helping them, because there is no way to reinvigorate the system without that. But that creates a political climate in which we have to be very, very careful. So the openness is important, but let me ask one of the important questions. You touch on it here, and that's the fear that you are insufficiently collateralized. The fear ranges from some people who believe that given the deterioration of assets with the best will in the world, it would be hard for you to be assured of that. There are others who think less highly of you than I do, who believe that this is some plot to enrich some bad people, but you are deliberately taking less collateral than you should. There are a whole range of opinions in between. Please elaborate. You talk about this. We've had some experience with the Bear Stearns. The AIG experience does not appear to be as hopeful as some had thought, but what's been the experience to date with the collateral, and how much assurance can you give the American public that however the money is, whatever the total is, and you'll be asked about that, how much of it is at risk? What loss can we reasonably expect to suffer?
Thank you, Mr. Chairman. I'd like to maintain throughout this hearing a very clear distinction between the 95% of our balance sheet, which is devoted to regular lending programs, such as lending to sound financial institutions or supporting the credit commercial paper facility, versus the other 5% of our balance sheet, which has been involved in...
Fair point, but quantify those. How much does the 5% amount to?
I will. The 5%, about $100 billion, is commitments to that have been undertaken in government efforts to prevent the failure of major financial institutions. I want to make that distinction. The 90%, the bulk of our lending, those programs are extremely safe. They are over-collateralized. I could go through each one I did in my remarks and explain why each one of them is safe, mostly very short-term, and very constructive.
And that would be about $1.9 trillion?
That would be at 1.9 trillion. 1.9 trillion, that's correct. The other $100 billion, which is related to the Bear Stearns and AIG operations, is a bit less secure, although our anticipation is that we will not lose money on those extensions.
Well, let me just say, my time is expired, and I think that's an important point, and I know you're going to be asked to get back to it. What you're saying is that people who extrapolate from the Bear Stearns and AIG experience to the rest of your holdings, that's too pessimistic. And I think that's a very important point that you're going to have to establish to people, because the most public ones are Bear Stearns and AIG, and I think that's part of it, is that people do not see those as safe, and then you're going to have to make clear that distinction you just made.
Thank you, Mr. Chairman. If I might, just very briefly, we engaged in those AIG and Bear Stearns transactions with great reluctance because there is no existing structure to resolve systemically critical non-bank institutions. If Congress would provide such a structure, the Federal Reserve would be more than delighted to step aside from such operations.
Well, very important.